My name is Vladimir Bosanac. I'm the co-founder and publisher of the registry. Thanks for joining our annual mid-year Silicon Valley mid-year broker forum. We have an excellent group of experts who are going to be talking about what's going on in the industry today and giving us a perspective on the market. So before we get started, I just want to give our panel here an opportunity to say hello and introduce themselves. So Mike Stein, I have you kind of here first next to me, so I'll start off with you.
Yeah, good morning. Thanks, Vlad. Mike Stein with Newmark. I'm a vice chairman in our Silicon Valley office. I specialize in agency and occupier leasing here in the Valley.
Wonderful. David?
Yeah, hi, good morning. My name is Dave Evans. I'm an industrial broker and I'm with Kidder Matthews.
Great. Mike Conroy? I don't know if Mike can hear us. Why don't we go to Bart, and then I'll see if maybe Mike's frozen. Bart, why don't you go ahead?
Thanks, Vlad. Bart Lamerson with JLL, focused on tenant rep side of the business in Silicon Valley and the Peninsula. Been doing it long enough that I've earned this bald head.
Wonderful. Well, I appreciate it. Looks like we may have lost Mike Conroy, but he'll probably be joining us here shortly. Before we do get started, we have one more guest who's going to join us who will focus on the multifamily market. Jimmy Castellanos from Mark Chap. We'll introduce him as he joins us. Also, he will be joining us just a few minutes late. Before we dive in, I want to take a moment and thank today's sponsor, Alliance Roofing, founded in 1986 by Rod Miller and now celebrating its 40th anniversary. Alliance Roofing has grown into the largest union roofing company in the Bay Area and a regional leader in commercial roofing and waterproofing across Northern California. From their Santa Clara headquarters, which includes an in-house metal fabrication shop, they've left their mark on some of the most recognizable projects in Silicon Valley and beyond, including work for NVIDIA, Google, Pixar, SAP Center, and Stanford's Graduate School of Business. They handle everything from single-ply, metal, and cool roofs to living roof gardens and below-grade roof waterproofing, all backed by a 24/7 emergency leak response team. They're award-winning, safety-driven, and deeply committed to their clients and their community. We are grateful to have Alliance Roofing sponsoring today's webinar. Thank you again for being there for us. Let's see, Mike Conroy, can you hear us?
Yep.
Okay. Why don't you also say hello? We didn't have a chance to hear you.
Yeah, Mike Conroy, the Econic Company.
Wonderful. All right. Well, so I'm going to ask everybody to kind of, go in the background, and Mike Conroy and I are going to kick off the conversation here shortly. So let me just also really quickly. Oh.
Almost.
It's I'm having some issues with my. Iconic. There we go. Okay, this is giving me some hard time. Mike, I think you tried to do it on your end last time. Do you want to try again?
Yeah.
Okay, so I'm gonna take everybody off to the side for now. There we go. Wonderful, Mike. So you are our retail specialist here today. Give us kind of a sense of where we are here mid-year through 2026. What are some of the things that is characterizing the market? And we'll give you like maybe 60 seconds to kind of give us a quick overview here.
It's still a good market. It's good, but it's different. It's the shifting sands of retail. We see quite a bit. Last year we were talking all about the different entertainment uses, and they're still out there. But it hasn't turned out to be kind of the trampoline apocalypse we thought we might have, of every large box space turning into a trampoline park. You've had some of those ethnic grocers we were hoping to step up, have stepped up. You're still seeing a lot of medtail, medical retail leaking into traditional shopping centers that what once might have been in more of an office setting, which is great to see and very helpful for retail because we can only do so much food in a shopping center. So it's great to see some of that show up. And that's kind of what we're seeing throughout the market for the most part, a little bit different.
Yeah, and I think you mentioned in our earlier conversation when we were getting ready for this webinar, there was kind of a sense a couple of years ago that 25 was going to be sort of a year of recovery. We've definitely gotten there with some submarkets, with some retailers. Tell us a little bit about kind of who is successful, where are things working, where are they not working?
The leasing has been strong. I think the tough part for people, especially interest rates, and there's much smarter people than I to talk about interest rates, but seeing the delta in those throughout the years, like call it the triple net investment group, especially single tenant net lease. 2020, you're seeing 52 billion in transaction volume. 2021, money's free, everyone's a genius buying everything. Every deal pencils. We flare up to almost 100 billion, around, let's say, $96 billion of transactions, up 85%. Then in 2022, start to see it shrink down a little bit. We're at 74 billion. 2023, we're at 43 billion. 2024, we're at 44 billion. So we're sniffing about half of where we were in the glory days of 2021. And the saying everyone was kicking around is like survive till 25. Well, it did work a little bit because you got up to around 51 billion, so a little bit of a blip. But what's interesting is 2026, you haven't seen it yet. We're, depending on who you talk to, down 20 to 25% in the specific triple net investment lease. And the lion's share of that is that $1 to $5 million value. More individuals, just slightly higher net worth people that are buying your Dutch Bros. They're buying your, lower rent Chick-fil-A in another part of the country, not here. They're too expensive here. But there is quite a bit of that. And one thing we were talking about before as well is I don't think I've ever seen as many larger shopping centers on the market. So you are seeing the delta of like those $1 to $5 million guys, which is again like the meat and potatoes of this, but you're seeing the larger REITs, the Blackstones of the world, right? Largest real estate owner out there. They bought ROIC for $4 billion, which is a huge vote for the West Coast in general. Grocery anchored shopping centers, their portfolio company is called Perform out here. So you're seeing some of those start to hit the market as well. Invesco has a couple sites on the market, the Burlingame Safeway, the Pleasanton Safeway, both like great opportunities to have some new landlords in the Bay Area. Pacific Commons and Fremont on the market as well, 1 million feet of retail. So we have quite a bit of like quality assets that we could see changing here, and maybe some new faces, maybe not, maybe the same faces are expanding, but seems bullish, even though those numbers didn't sound great a second ago. It's still pretty good in the Bay Area.
Yeah. Why do you think we're seeing some of these properties hit the market now? Are we kind of, they've completed their, business plans, they've owned it sort of long enough. We're on the other side of COVID. What are the drivers?
I think it's a little bit of everything you mentioned. And then I think also people are maybe losing hope on returning to 2021 type of rates. So they're like, hey, this is our new reality now. Do these deals pencil or not? I think their Excel spreadsheets are looking a little less exciting, but they're starting to look more realistic. So you are seeing more activity there. We're having more phone calls, walking through rent rolls and things like that. So I think it's more of like it's a new reality, and the deals are what they are. And, tenants still want to be here. You're still seeing, compression on the cap rate because it's the Bay Area. Tenants still want to get in the Bay Area despite all the, anti-California news you'll see that always gets some clicks on websites. It's like people are here, they're expanding, there's tons of activity, which is getting people bullish that they're going to be able to value add.
Yeah, it should be noted that Bed Bath and Beyond did come back to California after its kind of ceremonious exit, I suppose.
I called it last year. I said they can leave, but plenty of people want their space. So see you
Exactly.
later. And they're back. We're right.
Um, One other driver that you said is kind of indicative of where we are in the market. No new construction, correct? No new development, right?
Almost none. Regency has a project in Oakley that they built. So East Bay, nice Safeway center. They also have one in Morgan Hill, which will be a Sprout Center coming online. Um, Regency is like the only one holding the charge here. Maybe we see the Rise project in Cupertino come out. Everyone's kind of keeping an eye on that. It's just been we've been staring at dirt for years and years and years, but I saw they got a permit to do some rough grading of the dirt over there, so something's going to be moving. I'll be curious to see what comes out of the ground, but should be a great project. But you're looking at potentially 250,000 square feet of retail coming to the market. It'll be brand new. They're going to be competing with the same tenants you're going to be wanting at Valley Fair, Santana Row, the Prune Yard, Stanford. A lot of square feet there.
Yep.
So we'll be curious to see how that holds up. I mean, it should be fine, but it's like there's only so much to go around with the same few tenants.
Right. Unless they can also get the residential going there as well, obviously, right? Which will
That will
which will
help.
drive
We should.
the foot traffic, of course, right?
Agreed.
Tell me a little bit about, so you mentioned kind of we're in a bit of a world of sort of haves and have-nots, right? So there are some locations that are doing really, really well. Some are, continue to sort of struggle. Is there anything about the, space and the location that tends to do well and, tends to, find a new tenant that, others can learn from?
Yeah, I mean, a lot of it, as much as there's the obvious, like great location, great location, great location makes up for most everything. What you'll see is a lot of infrastructure related pros and cons to sites. So while some of the other guys that are going to talk today, they have much bigger issues with power, we're still feeling it in retail as well. A lot of these older spaces don't have the necessary power that a lot of these medtail uses really like. Multiple hundreds of amps, three-phase power, especially on the restaurant front, right? Converting a restaurant and coming out of pocket, north of $1 million on just like your basic little restaurant that you see, call it 2,000 feet, they got to come out of pocket, over $1 million versus if you're going into a space that already has, not to get too far in the weeds, but like a Type 1 hood, grease interceptor, the amount of power you need, that is $500,000, $750,000 back in your pocket. Not to mention HVAC on the roof. So while you see there's so few of those that are coming up, it's pushing the pricing so high on the ones that have it. We have a listing in Santa Clara, a very old Denny's building, dozen offers, full ask, little to no allowance. Hard to believe, based on the condition of the building, but it has that infrastructure people need. We have a listing in Mountain View. It's going to go for north of $100 gross. It's triple net lease, but just adding the two together, it would be over $100 gross, above ask, half a dozen offers on that, above the ask. So you'll see those, and then we also have some spaces that it's like a mixed use project, hard visibility, parking's not really there because parking's an afterthought on retail for mixed use buildings. It's like, man, those could sit for years, and they don't have a lot of the infrastructure we talked about, grease interceptor, Type 1 hood. It's simple math, really. It's like, why wouldn't we have more restaurants on the first floor? But every time you send a chase up through the building, you're removing rentable square feet or something sellable square feet above it. And you don't want to do that when you're a developer. So I understand it, but that's why you struggle to see some of those lease sometimes.
Right. What's going on with leasing rates? You mentioned this one example in the statement that you just gave, but how are leasing rates looking throughout sort of Silicon Valley, and then how do they go from A, B to C type property? Are you seeing a lot of resistance from retailers? What's the word there?
It's so asset dependent. There's some where you almost can't give the space away, right? And it's some of those mixed use buildings where there's all those issues with what you've provided, even though it is the afterthought of the project. But the better assets, like let's say call it the Class A stuff, you're sniffing $100 gross rents. A lot of that though is driven by the triple nets. We've seen those continue through inflation to just rise and rise and rise. And while everyone a lot of the time is thinking, hey, it's property tax related, and often it is, even those stabilized assets that people have owned for a while, the actual CAM, that common area maintenance of the triple nets, has doubled or tripled. Insurance is up. So it's a lot of these things kind of nipping at your heels that's creating that. And it's like, it is what it is. Your base rent might not be that big of a jump. And so it's like you could have $100 gross there. B, which is much safer. A lot of the B stuff, you'll call it like grocery anchored neighborhood centers. That gross rent has started to sneak into the 80s as well. You know, it's not crazy to be around a $5 a month rent. And now the triple nets are starting to sneak up into the 20s, give or take, of course. The only thing you haven't seen a huge jump on is like those larger box rents, you know, $2 a foot or, you know, $24 annually, still kind of been holding. And that's been almost like a decade of that. You will see an occasional grocery deal with a $30 number, but those seem to be few and far between. There's just kind of fewer players in that market, but those smaller 2,000, 2,500 foot spaces, super busy.
How do those rents compare to, you know, pre-COVID?
I mean, they're up for a lot of those reasons mentioned. I would say, you know, pre-COVID, call it like
You know, like the TNT supermarkets, sort of these Asian markets, right? Kind of the you know, folks like that, right? Tell us, you know, is that still you know, a group that's aggressively growing? If so, where are they growing? You know, what is the story there?
Absolutely. So our office reps TNT, they just opened at Westgate and they are doing some unbelievable numbers there. Just drive by, there's a line out the door still, which just makes you think there's a full green light for a bunch more. Obviously, I've heard rumors. I can't share exactly where else they're going, but they are very bullish on the Bay Area. You know, H Mart, we can talk about that a little bit more. Our office helps them out as well, different people in the office. But, you know, they bought a Kohl's box at Pacific Commons, 100,000 square feet. It'll be the biggest one in the country. They have a 75,000 footer in South San Francisco where they expanded into 24-hour fitness, which was their best store in California. I'm sure this Pacific Commons will now be the best, but you have TNT on fire, H Mart looking to buy stuff, not as much leasing, but they're buying. And then there's kind of everybody else. And I think everybody else is pretty scared because of what the rumors of TNT, now it's real. And I think for TNT, it might be going better than they expected, which means for everybody else, it's worse than they expected, which is a little scary, right? Good for the landlords that are talking to TNT and H Mart, but you know, the smaller guys are still out there, but it's a big delta between the two, especially in the credit.
Last couple of questions. I think this was sort of an interesting kind of point that you made in our prep call, the, you know, coffee wars. Tell us a little bit about that, and then as my kind of wrap up final question, I would love to hear from you. You know, a little bit like what you're looking forward to, you know, for the rest of the year into early 27. Are you looking at some drivers that are, you know, going to be indicative to you about where the market's heading?
Yeah, absolutely. Great questions. Coffee wars, full effect. I'm very biased because I have hitched my wagon on the Dutch Bro train, and business is a booming. We have quite a few deals going. I'm not sure I can say how many, like I did in the prep call, but it is going very well in the Dutch Bros department. Seven Brew has a very good operation as well. Have to give them credit. Great operators. They still have quite a few KFCs, but they are converting some of those KFCs to Seven Brews.
Are we going to see Luckin come in? This is the sort of the Starbucks of China. Are they going to grow in the Bay Area too?
You would think so. You know, they bought Blue Bottle, and we've had some Blue Bottle deals go on pause because it was kind of pencils down. They're trying to figure out what they're doing. So as far as I know right now, don't work with them. But as you know, having quite a bit of landlord rep, you're seeing pencils down. They're waiting to see. But I am cheering for them on the landlord rep side because I want to see more cafes. There is the coffee wars, but it's drive-through driven. So the Seven Brew Dutch Bro battle, civil war, if you will, is going on for most every drive-through opportunity. Starbucks is still trying to kind of reevaluate and figure things out. They're out there, but not at the full force you saw at one point where they said, "Hey, we're going to do 17,000 new stores," and it's like a Starbucks is on everywhere you look driving around. That's changed, but we really need something to backfill a lot of these cafes. That you're just not seeing right now. There's some Middle Eastern coffee out there that you're seeing in the Bay Area,
Yep.
like specifically Yemeni coffee, and all sorts of different names that are backfilling or trying to do that. But it's really like a Yemeni coffee is the core root of that you're seeing. But it's franchise. You're not seeing the credit. Landlords, you're not as excited about that, but they're paying great rent. So that is kind of your future cafe, potentially something that we're not really going to see nationwide, but due to the diversity in the Bay Area, which is awesome, you are seeing that. And then to answer your question of like what we're seeing in the future, I think, or how we're expecting the year to end, I think, like, personally, it's been a great year so far. I think it's going to end great. A lot of that is coffee driven. There's lots of activity on the landlord front. It feels like a landlord market on the shopping centers. There's very few spaces available, and people are battling for those. And I expect to see a lot of that. Just the cafe is a question. The actual walk-in sit cafe, I'm curious on that, but everything else seems to be full steam ahead. And Medtail is really kind of our, it's given a big boost seeing
Great.
those uses come into retail, and we're happy to
Great.
have it.
Awesome. Well, wonderful summary. Thank you so much, Mike.
Thank you.
We're going to switch it over to multifamily now with Jimmy Castellanos. Jimmy, can you hear us? Can you see us?
I can see you. I can hear you. Can you hear me?
Yes, definitely. Let me just make sure I get your. Oh. There we go. Oh, there we go. And Jimmy, you're with Marcus, so I'm just going to put M&M here really quickly.
Wonderful.
Although it's giving me, there we go, M&M. All right. Okay, so Jimmy, we didn't have a chance to hear from you in terms of just a quick intro. So I'll give you a chance to say hello and tell us a little bit about you and your group. Just a 30-second overview, if you don't mind.
Great. Yeah. I'm Bay Area raised. I grew up in Saratoga. I went to Los Gatos High School, and then I graduated Santa Clara University in 2017. I decided to start brokerage 3 days after graduating, so I jumped right into Marks Millichap in Palo Alto in June of 2017. And so I've been there 9 years. I'm a senior managing director, and I have really specialized on the sale of 4 to 5 unit, between 4 to 5 and 100 unit sales, primarily in Silicon Valley, with some exposure out of state, San Mateo County as well, East Bay, San Francisco. But my bread and butter has been Silicon Valley, and I've consistently stayed pretty active year after year. And I was raised in the industry. My family also owns apartment buildings in Silicon Valley and Santa Cruz County, and so it's what I know. Walking apartment units built in the 50s, 60s, and 70s is what I know, and I've learned to somehow like it.
Wonderful. Your parents didn't scare you away from the industry.
Yeah. No, they
Great.
did it.
Well,
They did it. But I have to say, Mike's industry. Oh man, I think I would have loved to get into that if I started over again. It's exciting to see the retail world and how that's expanding. I know it's super tight right now, but tracking which tenants are leasing what spaces and all of that. It's an exciting space to be in right now, especially in Silicon Valley.
no, for sure it is. For sure it is. So I'm going to ask everybody to kind of give like a 60-second overview of sort of where the market sits here midway through 2026. We're going to start the clock for you here now.
Okay, so I guess the only way to kind of talk about where it is now is kind of where it has and been in the past. But obviously in 2021 and 2022, I could say it was a bit of a bubble market in Silicon Valley in the sense that vacancy was up, rents were flat or down, mostly down. Vacancy was up, but cap rates were very low due to low interest rates, and price per units were high. The market was just very lively, but we saw declining rents and high vacancy, yet prices were still going up. And then, of course, in 2023, Rates doubled, insurance went up by 5 times for these apartment buildings, and velocity got cut in half in Silicon Valley. From what we saw in 22 to 23,
Wow.
multifamily transaction velocity got cut in half. And so it was a slower time in 23. We haven't, rents were still for the most part down, but we did see rents start to pick up again in 2024 in the summer. If Palo Alto had struggled with vacancy in 24, they were back. Rents were good, vacancy was low. We saw the same thing in 25, really strong. And then 26, I think we've noticeably seen rents take off. And probably they're up from the peak of 2017, 18, 19. So on the positive in the multifamily sector this year, we're seeing rent growth, especially in core pockets like Palo Alto, Los Altos, Cupertino, West San Jose, Sunnyvale. There's definitely a flight to good school districts, good locations, more west, but we're also seeing markets like Oakland pick up in rents, and that's primarily due to the push in San Francisco, which is
Sure.
leaking out to the East Bay. And so we have higher cap rates, we have higher interest rates, we have higher operating expenses, higher insurance, but now we are starting to see rent growth, and there's no sin that can't get solved with. My point is rent growth is going to hopefully help cover a lot of the hurdles we've had the last couple of years with higher expenses and rates.
Yeah, definitely. I think it's been a sort of remarkable story of Bay Area recovery. I think even as little as a year ago, a lot of kind of people were sort of writing off sort of what's going on in the Bay Area, and it does appear that certainly the rents grew. I think very quickly in San Francisco, and it sounds like it's happening across Silicon Valley and other parts of the region too. Also, sales volume crossed a $2 billion mark this year, correct? How does that compare to where we were kind of, midway through, COVID and, 2019 sort of, time frame right before the pandemic?
I mean, listings were like in 2018, 2019, listings were gold. No matter what it was so competitive that anything you list, you were going to sell. And so the challenge for a broker is just getting inventory. It's definitely easier to get inventory these days. I probably say that though because I'm a lot more seasoned in my career, and I have a system and a big team now where we're always bringing listings to the table. But the one thing I can say that's the same as 2018 to 2019 to now is if you list product in core Silicon Valley pockets, you're going to sell it. And the pricing for the most part has not gone down from the peak. It's, if anything, the same or if not higher in some cases. Now it's really polarizing because certain cities or certain pockets of Silicon Valley are down by, you could argue, 10 to 20% compared to what we saw in 2018, 2019. And so we've definitely seen a pickup in velocity. I would say some of these new tax laws that got revitalized from the Trump administration, the bonus depreciation, all of that does tie into it. You get these, obviously the stock market's done very well, and a lot of these engineers here locally want to diversify. They want to offset some of their capital gains, buy real estate, do cost seg studies, all of this. So that's helped keep the market lively. But I think for the owners out there that can try to look around the corner the best they can, they're starting to see rent growth, and it's a great time to jump in.
Are you noticing a new type of buyer, or is on the kind of smaller segment still kind of the mom and pop local investor, or are we noticing some institutional folks come back into the fray? How does the market look from that?
I mean,
from that point of view?
there's kind of a new age of investor that's come in over the last probably 10 to 15 years in Silicon Valley compared to what we saw 20 to 30 years ago. I mean, there's still the mom and pop owners. I think it's different though. The mom and pop owners are, both engineers, high household income, and they're working 20 hours a day. It seems like they never sleep. Their engineers are smart. They're buying real estate. They have multiple careers going on. They're super smart. They're great to work with. They can understand a market really quickly. So I think it's always been the case in Silicon Valley, but there's definitely a younger kind of buyer that's starting to come in, 30 to 40-year-old demographic, and
Yep.
And what was the other question?
If you're seeing some institutional folks coming in,
Yes.
have they come off the sidelines?
You're definitely seeing more institutional syndicate groups that were heavily looking in Texas 5 to 6 years ago that are jumping back into the market. The challenge they're facing is, although cap rates have come up and pricing has come down in Silicon Valley and rents are on the move, it's really hard for them to find inventory. It's still really competitive. There's not a ton. There's not a ton of deals out there between the 50 to 200 unit range. Garden style building, Silicon Valley, you're not seeing a whole lot of that. And so there's definitely I mean, I would say cap rates have probably dropped a bit in the last 12 to 24 months with some of those larger products, just due to the sole fact that, you can only sit on the sideline for so long when you have money ready to go. And, some of these investor groups are forced to take lower yields.
What's your perspective, and not to call out anyone specifically, but I am curious. What is your perspective on sort of the pro forma rent growth? I mean, it's been a remarkable year over year. You said we're above sort of the levels where we were back in 2019, which was at one point also kind of record as well. Do you think that there's more room for growth? Are you concerned about that?
Yeah, I mean, I think rents are starting to catch up with what we saw with inflation. So finally, I mean, we saw states and, we saw Texas have tons of rent growth, Florida. But I think, finally we're starting to catch up to what these other states saw a couple years ago. I mean, it's tough to imagine rents just can keep going up the way they did from 2011 to 2017, 18 here in Silicon Valley. But I guess it's really driven by the AI tech market, and if there's some unforeseen bubble out there that none of us can see, then it's going to probably soften the rental market. But the one thing that we can rely on, even if there's some type of recession here locally, this year in San Jose, the heart of Silicon Valley, there's 160 new units being delivered to market. So there's like extremely low inventory.
Right.
The prior 2 years was over 6,000 units delivered to market. So compared to any other big metro in the nation, we had the least amount of new units coming to market. If you couple that with extremely strong tech industry, job market, it's hard to, I do think we have maybe a healthy runway over the next couple years of consistent rent growth that'll hopefully help some of these owners catch up to what type of expenses they've seen increase massively. And so
Yeah,
I think
definitely,
we're kind of
definitely.
protected. I think we're pretty protected here in Silicon Valley. You're not seeing a lot of, I mean, anything that's going to get developed has got to be over an acre. There's just not a lot of parcels that are over an acre that are developable right now. Construction costs are only getting higher. And so I think I would say even if we do see some type of recession in the tech industry, I would think that rents will probably stay stable, and probably it definitely does have some room to grow.
The one concern that I have, and tell me if I'm on the right path here, but rent growth initiatives may start to pop up again, right?
Yeah.
What is your thinking there? I mean, there are some cities. I believe Redwood City is bringing something up on the November ballot. Do you foresee that as being a hurdle to the industry?
Yeah, I mean, the one concern is that we continue to see a big pop in rent growth, and then we continue to see these cities hammered down on, new rent control policies. Or like Redwood City is one of those that has rent control on the ballot come November. I feel like it's probably going to pass. Mountain View passed it in 2016, Measure V. San Jose's got rent control. So, it definitely, if you look at like New York City is a good example of like what could happen when you have government step in and put extreme rent control policies in. But I mean, we were looking at New York City's like average, like the average deal that's selling below asking is like 30 to 40% below asking in Manhattan for rent stabilized buildings. And so I'm not saying that we're going to see that here, but if we see government step in and try to solve the problem by creating rent control, which doesn't help with new housing, I mean, that obviously is going to be a major impact
Yeah.
and pro forma rents and all of that. So it's tough to, I think we have a good mayor here in San Jose, San Francisco. LA's got a lot of other problems, and even recently, we've been getting a lot of calls from owners in LA who want to explore reinvesting in Silicon Valley just based on the difference in political environment. So,
Right, right, and they had that ULA tax down there, which is I think hurting some of the sales as well. Last two questions, really quickly. SB 79 took effect a couple of weeks ago on the upzoning. Is that going to help the industry? Are you optimistic about it? And then my last question is around, what are you looking for here towards the end of the year into 27? Are there some markers or some drivers that are really important to you that you're gonna, especially be looking out for?
okay, I'll first question is the upzoning. I mean, I think all of this is great, but I mean, if it cost $900,000 per unit to build a building and then it's worth 650,000 after you build, I mean, that's the problem right now. So the cost is so high to build. There is a project going on in Santa Clara University, right across the street, in front of the Safeway there. It's like 39 apartment units with retail on the bottom. It's a really nice
Yep.
building. I mean, the developer, the money tied to there is just super high net worth group. They probably realize that they can build this and, after it may be worth, but they're not sellers, right? You just don't have a lot of developers though that are going to be building okay with just holding. I mean, it's a lot of merchant developers that, they all their debt structure and all of that, they would have to exit within a couple years. And I mean, the whole replacement cost right now is a difficult thing to overcome. And so I think if we start to, I think we just have to be in a different market to start seeing
Yep.
more sticks in the ground and actually development taking place. Yeah, and it's hard for me to imagine. You can drive around Seattle and see the success they've had. It's hard for me to imagine that's going to happen overnight here, even with these new bills being passed. And then the second question was
on the sort of markers. What are you looking for? What will be something that's important to you to look into the industry, here towards the end of the year to kind of give you a sense of whether where things are heading.
rental market. I mean, the rents are everything. So that's what we're really focused on right now is where are we seeing the rent growth, and is it going to stay consistent through the fall? I mean, so far it's been pretty strong through the summer. I would think it stays consistent through the fall. It's going to slow down a bit in December, and then what are we going to see next year? Are we going to continue to see this? Because if we continue to see strong rent growth, I mean, that's going to help us a lot as far as getting our listings moved across the finish line. We can see it first, but once the news is out that, hey, Silicon Valley is continuing to see rent growth year over year, which San Jose is one of the strongest rental markets right now in the nation behind San Francisco, then we're going to start to see buyers jump in a lot more aggressively. But
Yep.
Obviously it would help if we see some type of adjustment in interest rates, so which I don't think is going to happen too soon. So I'm most focused on rents right now. Yeah.
Interesting. Very good. Very good. Well, Jimmy, thank you so much. I really appreciate you taking the time to be with us. We're going to jump over to Dave Evans on the industrial side.
Thank you, Vlad.
Well,
yeah, thank you.
Thank you. We'll talk soon. Thanks, Jimmy. All right, Dave. Good to see you again. As I've asked everybody here to kind of give us kind of a 60-second overview, I'm going to ask you as well. Give us kind of a quick rundown of the industrial market across Silicon Valley.
Yeah, thank you. I mean, right now, the industrial market is in really good shape. It is at about a 4.6 vacancy rate, which is good. It's not the 2% that we had during the pandemic. But I mean, over the last 8 to 10 years, it's really averaged between 2 to 5%, which is very good, very strong. So that's encouraging. The other thing that's really happened this year that was completely an improvement over the last 3 to 4 years is the amount of net absorption that's happened, space that's actually left the market. and reduced. It's so far this year, it's about 1,300,000 of net absorption, and that's just fantastic. 151% or 150% over last year. So that really bodes well. There's just been some significant industrial transactions, leasing primarily, and they're all really tech centered. So they're high
Yeah,
tech.
let's stay there for a couple of minutes. Tell us a little bit about what are some of your figures showing in terms of like absorption and that kind of stuff year over year. Have you is it a remarkable year? How does it compare to some of the highs that we've experienced maybe 3-4 years ago?
I mean, 2 to 3 years ago, everything, not everything, but so much of the market was driven by Amazon and like carriers. They were taking down millions of square feet consistently, and that was remarkable, and that obviously helped. Asking rents helped vacancy rates. They have slowed down a bit, but that has not created vacancy. I think they've pretty much found their sweet spot. There's a couple of things in that logistics 3PL market. UPS just vacated 175,000 feet up in Sunnyvale, but primarily the available space for that kind of product is low. So this recent level of deals is really pretty amazing. Pretty amazing. I mean, Super Micro, NVIDIA, Archer Aviation, of course Tesla continues. I mean, it's amazing.
Yeah, and this differs. I mean, if you look at what Amazon was doing, I mean, this was mainly for sort of distribution space, right? These other
Correct.
companies you just mentioned, this is like AI, R&D kind of stuff, heavy sort of energy usage, right?
Absolutely.
That seems to be driving kind of the industry. Is that correct?
It really is. Power is such a key component in obviously the big deals and the data center deals, but also even in some of the smaller tech industrial deals. I mean, we've had a building we've been working on up in Palo Alto, and we get interest, but the amount of power that everybody wants is amazing compared to what it was 5 years ago. And again, it's because of AI, it's because of vehicle related, electrical, those kind of demands. So power is so important. And it's really benefited the market where these tech guys and AI, of course, have just gobbled up a tremendous amount of space.
How does the industry compare if you look at sort of Class A, B, C, space? Equal amount of interest, or do some stand out?
I was trying to, for the presentation, trying to really characterize the market. It is really a two-part market. It is everything about high tech and power and AI and formerly the logistics, but right now it's so much about that and high quality. The rest of the market, which is where I spend a lot of my time for many decades, is more of the BC product. It's not sexy. It continues to kind of slowly disappear as other development requests, cities and governmental authorities. I mean, the BART extension is probably going to take well over 1,000,000 square feet of industrial space off the market. Google's foray into San Jose, which is a little bit on hold, has gobbled up a tremendous amount of square footage. So the BC stuff, which really drives, I mean, anybody who fixes your car, anybody who fixes your air conditioning system, has a small wholesale business, delivers locally, all these kind of things, that space is continuing to shrink. So, the bad news is it shrinks. The good news is it shrinks because it protects that asset class. If you own that kind of property, you you have something that absolutely cannot be replicated. The costs are prohibitive. So you've got these two markets that kind of they work together because obviously the BC stuff supports even the NVIDIAs and stuff on prototypes and all that kind of stuff. But it really is a tale of two markets. So.
Have you noticed that sort of the Silicon Valley or kind of the closer to the Bay market still tends to be sort of kind of on the smaller scale compared to, let's say, what's going on in Central Valley, right? Are we kind of like the last mile sort of still in industry or is that evolving?
It's to answer your question, we are a smaller building kind of. We just don't have the land, so
Sure.
it's been difficult. But developers are really looking to, and users are looking to nail down some bigger, high-powered buildings. There's just it's hard to find that land. Out in the distribution belts, out in the Lathrops, and in the Central Valley, there's still acreage, so you can throw up a 1 million square foot building. Here they are building large buildings, but it's very, it takes a lot to find the land. Usually it's knocking down older and Class B and C industrial buildings and then redeveloping. So I just think we're going to get the more precision requirements. I mean, Supermicro takes down 700,000 feet. That's not a small deal by any means, and it's a new product, but in general, there's a little more resistance to that redevelopment in this market, which makes it so valuable when the rent's up.
Right. I've noticed some kind of like national stories is that industrial seems to be not this little golden child as it was maybe a few years ago, but you're seeing some of the circumstances and kind of some of the innovation going on around Silicon Valley. This market still seems to be performing well. Are you seeing that in rates also, like year over year? Where are these rates compared to where we were at the peak of 22, 23, and even further out if you look at like 2019 time frame?
I think what the rates have done in general is slowly and gradually raise over time, and it's just been like a nice slow progression in rates. So there hasn't been anything wild and crazy. I would say there were some rates way back in the day around the .com when it was kind of fanciful and it didn't really hold water. But as far as the industrial market goes, it's grounded and it slowly grows. And then it really depends on 2 or 3 years ago, it was the Amazon and the logistics. Now it's the high tech and the power for that market. The rest of the market just kind of flows along with interest rates, with operating costs. The cost of insurance and stuff has gone up a lot. There's a lot of small businesses are very sensitive to rate, more than some of the big companies who just need the infrastructure. So I would say we're still kind of finding our way, small businesses right now. So I would say it's a very moderate rent growth that I would continue to expect to sustain itself unless there's some oddball thing. But in general, things are just holding together.
Yeah. Two kind of recent, sub-markets that have been in the news. City of Fremont has done some interesting stuff. I think they've grown their industrial, I think, inventory, quite a bit over the last few years, and that seems to be
Yes.
gobbling up very, very quickly. And then most recently, there was an announcement, and you mentioned this earlier, Archer Aviation, which is one of these, essentially an electric eVTOL is what they're called, but electric kind of vehicle, propeller-based sort of personal carrier is how I would like to describe it, right? They
Yeah.
leased about 500,000 square feet in Morgan Hill, which is sort of on the boundary, I think, of Santa Clara County. Is this where you see some of the bigger growth happening because of space? They have a little bit of space, I think, in Fremont, maybe more down in Morgan Hill. Is this where the bigger kind of things we're going to see expanding?
I think the Morgan Hill deal was, and I think you alluded to this in some of our talk, was, to what distance will people go to get what they need, to get that power or to get the building space? Morgan Hill has always been a little bit of a stretch because of the commute time and the transfer. And I think this probably was a deal that they decided that those buildings, which had been on the market for quite some time, really gave them the only opportunity to get that amount of square footage and proceed with what they're proceeding with and looking to pursue. And I personally think that that company is probably going to be going into this wave of drone technology, which is happening all over the world and in many different applications. So I think they just said, we need to get space, and we'll quote unquote drive a little farther. Fremont, I've been in the business for many years, and Fremont was always the kind of the first to fall when things started going south. It was Fremont first. Well, no longer. Fremont, I think, seems to provide a good location. New, quote unquote, newer buildings, maybe more power per pound against the older buildings in San Jose. And Tesla and the related technologies and others are really taking advantage of that. So Fremont has really become, the rents in Fremont are on par with, the South Bay. So they've done very well. And there's some great product out there. And I think as far as new development, it's going to be still kind of hit and miss because of still the availability of land. There's more land in Morgan Hill, but it's a small city, and you get down to Gilroy, it gets a little tougher. And I still think they're a little distant, but Fremont is solid. Fremont is very solid. Just a question of finding the land and being able to put the building up for the right cost to make it pencil. So
Right. There are some parcels around City Hall that I'm sure they would like to get used up. I'm not thinking industrial is going to be the best use for that. So as a final question here, what are some of the things you're looking for in the rest of the year and into 2027 that will kind of give you a sense of where the market's heading? What are the sort of most important things that make sense to you?
The issue of power, I think the continued issue to provide power. I know the city of Santa Clara recently, I think, has found some more power, which enabled NVIDIA to lease 500.
Where did they find it?
I don't know. They found it somewhere, believe me, but they did. So that kind of enables NVIDIA to take a 500,000 square foot data center, which was not happening. And and that's going to allow these other users to, hopefully take more space. PG&E is active in expanding their infrastructure. So this is great news because that allows these tech users to stay here. The market is kind of an older, balanced market. So I just kind of look for demand, transaction flow, numbers of deals. I represent both landlords and tenant buyers, trying to position the properties right. There's so much of a variance in this BC industrial product. It's a huge market, but it's not cookie cutter. It's not like track houses or anything like that. It's just very individualistic, but it's in demand. So I'm just looking for business climate, general confidence, and maybe interest rates if they came down a little, which we don't know, but that does have an impact. So it's nothing crystal ball. It's just kind of keeping an eye on the steady progression of the market, but which is a nice thing about industrial. It's not I don't know what the word is, whipsaw or whimsical. It's very steady. It's a very steady product. So.
And quick kind of industry prediction for early 27 or end of 26, sort of steady as goes, you think, or do you anticipate any kind of things changing?
I would say steady as it goes, and a lean to the positive. So with things that are going on and with power and low vacancy rates. So that's my thought.
Wonderful. Dave,
All
thank
right.
you so much. Great overview. Really, really appreciate it. I'm going to have Mike sign and Bart Lamerson join us here. Let's see here just really quickly. Okay, Mike and Bart, welcome both. You guys are obviously on the leasing side, but have some perspective into the investment sales side. I'm not gonna torture you with that too much, but I would love in your quick overview for both of you to give us a little bit of a sense of where things are. Also with the sales across the commercial space here in Silicon Valley. Mike, I'll have you start.
I think wherever you look across your vantage point of this market, if you track demand, if you track absorption, if you track vacancy rates, it's as healthy as it's been since before the pandemic. To be at north of 10 million feet of demand today across all office and R&D leasing activity is remarkable. It's 7% higher than where we were on a pre-pandemic basis, and obviously 40% plus higher than kind of this post-pandemic hole we've been climbing out of. The first couple quarters of this year on the office leasing front have been fabulous. We just booked 3.1 million square feet in the second quarter of this year. That's the highest quarterly gross absorption we've seen since the third quarter of 2019. Vacancy rates have dropped across office 330 basis points from a year ago. Sublease availability is down 40% from where we were a year ago, as product has been brought off the market due to a return to office, and the best-in-class product has been absorbed. R&D has been steadier than office, but kind of fallen a little bit of the backseat as kind of office leasing has roared back. Last quarter was a great one. It was 61% higher in terms of total R&D deal flow that happened a year ago, with positive net absorption of just over 400,000 feet, compared to actually negative net absorption we saw in the first quarter. An overall basis, if you look just nowhere else but the tenants in the market, it's more diverse than I've seen in my entire career. Obviously, we have incredible household names that kind of grab most of the spotlight of the headlines, but when you kind of dip below them and you see everything happening in hardware and software and all things AI, you also see, medical technology companies growing, air tech, everyone that feeds the semiconductor ecosystem, robotics and, auto tech that has its roots pretty deep into the valley. So,
Yep.
Kind of just to my opening statement, whatever your vantage point is, whatever stat you look at, it feels about as positive as we could, ask for it, this kind of post-pandemic period that we're
Yep.
finally out of.
Yeah. Bart, your perspective, same question. Your perspective on the industry here as we close the first half of 2026.
Yeah, I'll start with the capital markets side, and echoing what Mike said. We're seeing more activity around the market across all really submarkets and product types. So if you talk to your colleagues or friends in the capital market arena, as well as some of the leasing brokers that are contributing market factors to prospective buyers that are evaluating projects, those calls, those meetings, those conversations are way higher today than they've been since the pandemic, no doubt. We're seeing it throughout, both on leased investments that owners are looking to exit, as well as some of the surplus campuses now that could not clear in years prior that have cleared in the last, call it 12, 18 months. Notably, the VMware campus that sold last year, Pac Shores sold from Google this year. We've seen some recent activity around the market. There's more to follow with what Juniper's going to do, or HPE Juniper. So we're starting to see the reemergence of these value add buyers. And the reason they're doing it is because of what Mike hit. The leasing markets are as strong as they've been since the pandemic. You can find stats that said they're even stronger than the years leading up to the pandemic if you want to pull apart certain factors. Sublease rate, as Mike mentioned, I think it's an 8-year low as a percentage of availability. The number of renewals is down, meaning either new entries to the market with all the new AI technologies coming there, or tenants that were in space now are not staying in that same space. And when you couple that with the activity and the absorption we're seeing, generally means we're taking a positive step, 50 to 100, 20 to 50. We will have those that go down, and not everyone's going to go up. But I think across the board, and echoing Mike, this is really a really good time for the capital markets as they're hitting stride, and the leasing markets are ahead of them and pulling the capital markets up. One other thing I would note, we talked about earlier, we went out at the beginning of 25 and looked for a 100,000 foot plug and play option in Silicon Valley for a client. They wanted a flexible term. We had 25 options. Today, we refreshed that search today, there's less than 5. So it's just a testament that there has been real absorption, there has been real demand on that Class A sector. The other thing I think that's kind of funny, and it takes a minute to think about, and it may not be just this second quarter, but there have been quarters in the last 4 where we see average asking rates after the quarter go down, yet leasing's up, and you scratch your head thinking, why is that? It's because the top Class A stock is being leased. So the $5, $6, $7 net rent deals are the ones in demand. The Class B buildings that struggle, that are out there in the $3, $4, $5 equivalent submarkets, are not yet seeing activity. So as those new top Class A buildings come off the market, what's left is a more Class B heavy stock. So that's where it's funny as you start seeing some of these markers. But when you peel them back, you realize that's because the new product, the Class A product, is in demand. Tenants are stepping up and paying for it wherever the submarket. And now we're looking at what's going to happen next, because as we know, there is no new construction on a spec basis out there. So tenants are looking at either repurposing what they have or going out to elevate the Class B sector into something that they can take for their companies.
We've seen that. Yeah, Mike, go ahead. Sorry.
Yeah, and I would say Bart makes a great point about some of those sort of statistical moments in time that don't make any sense. And if you look back at the second quarter gross absorption, or the deals that got done, 71% of them were in the Class A market. And if you peel that back and you look at just trophy office market availability, that availability rate is 7.5% compared to roughly 17% across the more general Class A market. So I think Bart hit the nail on the head, and the statistics of the last quarter completely back that up.
Yeah, there's been also some indication, if you compare it to like what's happening up in San Francisco. I think the vacancy is still over 25-ish% or so. But when you peel sort of the onion a little bit and start looking at space, that's actually the type of stuff that companies want. It boils down to basically closer to maybe 15%, right? Are you seeing similar stuff in Silicon Valley as well?
From a tenant's perspective, absolutely. A submarket that has whatever vacancy doesn't mean that's the number of good options you have, because of those comments around either older stock, assets with inferior infrastructure to support what we need, or our tenant needs. And I think, the city is, while it's a much bigger, grander scale of it, more segmented in the office sector only, it does resonate down here. Not that the headline, you can't believe it. You got to peel it back to really look at it relative to what you're looking for, because those numbers are going to be misleading if you just go by top line vacancy, either in the city or even down here, because it's not necessarily as available as it may seem.
Yeah, I think how the demand is progressed through the Class A inventory has been interesting to watch. Santa Clara Square certainly got that ball rolling, and probably the most occupied large-scale office project in the Western United States. Santana Row, Santana West building that I'm sitting in, obviously is fully occupied. Obviously, what we've seen in downtown Sunnyvale over the last year and a half has been best-in-class shell product, amenitized in an urban environment, served by public transportation. So that demand has gone from the best-in-class product into product that has a high-quality pre-built environment, both direct and sublease availability. And saw that at Tech Corners, saw that with a project we worked on for Zscaler and the Airbnb sublease. And so, where that demand is shaking out is to a much shorter list of options, to Bart's point. And that's where, I think we're starting to see well-located projects that don't have the quality of the amenity base that tenants desire today, and landlords making significant reinvestments and bringing those projects to, I would say, a 2026 standard. So from, again, best in class shell space to best in class pre-built space, I think what we'll see in the next year to two are major modernizations and reinvestments and real estate that is great real estate, but coming up to a standard closer to something that's been built over the last handful of years.
Yeah, is most of the interest in the sort of high end Class A and then down to regular Class A, then Class B, Class C? Does the vacancy kind of follow that path as well? It's lowest in the higher end product, and as we go down to the lower end, it increases dramatically.
I think for the most part, that's right, Vlad. There's some exceptions in a few of the submarkets around the valley that still have a little bit more of a tenant leverage lean to it than more of a landlord's market. I always segment out sort of the scaling startup universe, our wonderful mid cap companies that are either going public or effectively doing a private IPO through these massive funding rounds, and then kind of the larger scale household name enterprise tenants. And so each of those groups has different drivers and motivations, but to see over 70% of all office leasing that happened in the second quarter happen within that Class A vertical, I think pretty much tells you what you need to know about where that focus has been.
What about leasing rates, or is there anything about the sort of demands that tenants are trying to ask for? Has that been evolving? Are you noticing that change at all, or is it kind of basically where it's been in the past?
From my end, I see the tide rising in rates across all sectors. The Class A that's getting leased up has optimism. They're bullish. What's left is being reevaluated in terms of where they are. And Mike, you work with landlords, so you can share that perspective. But from our end, even what would be more, and I say this in the most complimentary way, commodity office space, well located, but it's not new. It's not 2016 or newer, but it functions as good office space. They are also raising rents. We're seeing asking rates. We'll see if they can achieve them. Sometimes it's with an equity event where there's a new buyer, a new investor. But the fact is the foundation is there for someone to make the business case that momentum is coming towards the office, the vacancies, towards the landlords. They can push rents a little bit and get away with it just because the fundamentals are there.
Yeah, we obviously track asking rates, and I just went back and look at where we're asking rates in the major office developments across the valley, the start of the year versus today. You saw some that have asking rates as high as 30% higher than what they were asking in January. 5% was the other end, but the average across all average asking rent increases at all of these projects we know well was roughly 11%. While I think that's well justified for all the reasons kind of stated before, I think the reality is tenants appreciate it as well. And so all of these new deals that are getting done, whether they're 50, 100, 300,000 feet, from a rent perspective and from a net effective rent perspective, when you peel back all the concessions, are really building on the ones prior to it. Santa Clara Square is probably the best evidence of that now, signing leases north of $5 net. I think, though, the speed at which this market is moving is very emblematic of the time in the world that we're living right now. These companies, so many of them, whatever vertical they're in or product that they're evolving, are in a foot race. In that foot race, if you're second, third place, you may be out of business. And so seeing companies that are coming out of stealth mode with $400 million of funding, touring and signing a lease in roughly a month and leasing 60, 70, 80,000 feet out of stealth mode is something I personally haven't seen in my career. Sounds, reminiscent of what happened in the dot-com. But rates, tenants appreciating the market is moving, the speed at which these companies are iterating and evolving, and just, what that is leading to from a transaction, timeline standpoint, has surprised me quite honestly over the last year.
Mike, on the 9 million square feet of demand that you guys are tracking, anything you can sort of share there in terms of like the size of the requirements and the types of companies?
Yeah, we're tracking just over 10 right now. It's kind of interesting, when these bigger deals like a Pure Storage or like an AMD, come off the board and come out of the market. There really has been a nice steady backflow, and we're constantly monitoring that to evaluate the depth of the demand. But from my perspective, in the office arena, those 150 to 300,000 square foot, not quite full campus users, but taking a good chunk of space and occupying a good percentage of a campus, feels where the heat map is pointing to right now. On the R&D front, I would say 30 to 50,000 feet. These are companies that might be a pretty young scaling startup collecting a massive funding round, or they're just a wonderful, larger company that has a lab here in Silicon Valley, or they're part of the, supply chain of all things semiconductor. Where on the R&D front, if I look at, all of our listings and all of our tenant projects right now, that feels to me where we're seeing the most competition, kind of a shorter supply list of quality product. So office versus R&D, that's how I segment it right now.
Yeah. Bart, what about amenities? What are tenants looking for? Are they really adamant about certain things?
Yeah, I think they are, and that's where you saw the Class A leasing volume in the past 6-12 months. Those Class A buildings are very well amenitized, whether they're located within CBDs like what we saw in downtown Sunnyvale, or they're providing it on campus like we saw at Santa Clara Square with the Irvine Company, and that's not new. But that is drawing and attracting tenants. Commute's another thing. How are we getting our people to work? Where are we located? Over COVID, when no one was really going in every day, we're starting to see return to work. The RTO is shifting to more, not less. More days in the office, not fewer. And we're seeing that now become an impact of location. If you cannot find the amenities, we're seeing tenants, start to really understand they're going to have to provide it for themselves to compete on the talent. Instead of being in a downtown CBD or in a mini-rich project, they may have to bring in their own cafes and fitness centers and things inside their own square footage, so they can be on par with the other projects and the other best-in-class users in the market. But it really is still amenity-driven, location-driven, more so today, I think, than even a year or two ago because of the commute impacts we're seeing in the market.
There's been some talk up in San Francisco, that the companies are, paying folks, extra money to be closer to the office. Anything like that happening, around Silicon Valley? Is that even possible? I don't know, but I am curious. Is the location of residential or proximity to residential, one of the big considerations?
I would say it's on the list. It's not a top priority, like find us an office building where there's apartment buildings across the street. It's always in the let's compare and contrast alternatives. If there is proximate and large scale proximate residential, that always gets noted as a positive. If they're building 400 apartment buildings, a block away. I know when we did the original TikTok lease down in Coleman Highline, sublease actually with Verizon, the emergence of the 2 apartment buildings immediately to the north was an interesting anecdote that they said if they have people come over, they could grab corporate apartments, especially for an international tech company like ByteDance, and be able to place their people that come over for extended stays in an apartment that's a very short walk. They don't have to navigate public transportation or Ubers or rent cars. But right now, I wouldn't say it's a key driver, but it is noted when you start looking at some of these large scale developments proximate to office opportunities.
Yeah, one interesting discussion point that we had in our prep call, you mentioned RTO 2.0, basically, right? Companies are now looking at a sort of a second iteration of return to office. Give us some insight into what you're seeing.
Yeah, and I think it is the 2.0, maybe 3.0 for some that were on the front end of it. As we came back from COVID, people trying to perfect utilization, ratios, how many people per desk can we fit? We've got these floating 2-3 day week schedules. Some are mandated, specific days, some are by group, finance are these 3 days, engineering are these 3 days. And as they put those to practice, they now have the benefit of feedback from the people that come to work every day. This is not working, this is working. So we're seeing, and I'm seeing, a lot of our tenants are seeing a shift through that, where they've taken the original thesis of how we're going to come out of COVID, return our people in that first phase back to the office. Now they've been there for some period of time, quarters or years, and we're seeing a shift. I think anecdotally, they're coming, the ratios are down. So I had a client that almost had a 2.0, 2 people to 1 seat. That's a 2-day-a-week schedule. The Monday, Tuesday crew, the Wednesday, Thursday crew, Friday's a free-for-all. That wasn't working for them. They now have to bring 3 days a week. You do the math, it doesn't work unless you sit on each other's laps, and that's not going to be something viable. So now that 2.0 target headcount per seat is falling to almost 1.25. So through that, they've learned and adjusted. Now, what it means is they're taking internal measures with space allocation, using some of the soft seating to more dedicated seating. But it also means some around the market looking for expansion, just because they had so many heads and so many seats. At some point, you can only reconfigure soft seating to a point. Then you have to go find incremental space. And we're seeing some of those come through just because of executive decisions or leadership decisions to make a shift back to the pre-COVID 1-to-1. We're not quite there. Some are, but for the most part, it's trending that way, which has also fed some of the leasing demand.
And
Yeah.
I think it's really interesting, given we all just went through a public health crisis, fortunately, a number of years ago, to see what changes that experience has had. And I think what Bart is describing is the result of that. But, no longer, I think, are people comfortable with being as dense as, we were back in kind of the web 2.0, with kind of Twitter, the poster child of packing people into, that San Francisco Market Street campus
Benching,
at
the whole benching
120.
phase.
Yeah, so that's gone. I think employees really don't want to work in a single seat or a single desk all day long. They want to arrive, they want to, stop in at a hospitality type experience, kind of a visualized hotel lobby, and maybe, have the first 45 minutes of their day there. They'll certainly have some heads down time. They might choose to work in a more collaborative area to be a little bit more open to, having a conversation with their colleagues. And obviously there's, time spent in meeting rooms. So multiple places throughout the day that have multiple types of work environments seem to be on trend in space planning. I think, back to the commute for a second, I think no longer can an employer expect employee to do a 3-hour round trip daily commute. We all know this is unfortunately more of a car commuter, market than anything that's leveraging public transportation. But the really long commutes and not looking at commute studies and demographics of employees and making decisions on based where executives' housing are, I think the employees are getting a lot more consideration over the last few years. And Bart spoke to the iterations and data that are coming from, operating these facilities finally, and getting to, engineer what the right program is for a particular company. So pandemic influence sort of behavioral patterns and how employees are treated and what can be expected of them is something that I've found most interesting over the last number of years, that flow through into a lot of the real estate, decisions that are being made.
Yeah.
The other thing I'll add too, what we're seeing is the emergence of not just, how do I know that that employee came to work today? It's a 3-day requirement. Mike, to your point about the lunchtime crew, badge in at 11 o'clock, make the rounds, high five some people, be visible, go into a meeting, grab lunch and be gone. That badge shows you were there that day. So we're seeing, some look at that next stage of, okay, not only are you there that day, the expectations are ours, right? You're on campus because it's not a 5-day a week. We're deliberate about how we bring people back. We want that FaceTime. We want that, energy that the 2, 3, 4, 5, 10 of us build off each other in a room or in a team to solve a problem or tackle a challenge the company faces. So we're seeing some of that come through as well. It's not just the 40 badge swipes. It's, were they there for lunch or were they there for a meaningful contribution to the in-person experience? Because we're only requiring it 3 days a week, not 5. There is going to be that pressure. And I think the commute thing will be interesting, because I agree with you, Mike, in some ways that they're getting more sensitivity. I've also heard some say, I'm not making them come in 5 days. They can choose where they live. If they want to take that extra time in the car to live in that part of the bay that they want to live in, that's their choice. And I'm not as sensitive to it on a 3-day-a-week requirement as I would be if it was 5 days a week. So
No, good.
it's still evolving, and it's going to change, and will continue to change because we're people and we're human. And we have life around us and feelings and emotion. And the hotter the tech company, the probably the more they have control of it. The ones that are trying to recruit and scramble to compete with some of the higher end, more desirable jobs are going to probably have to provide a little more flexibility. So it will change, and it will not be the same for everyone.
The employee Bart described, I heard a well-known employer here that will remain nameless would describe that individual as a coffee badger, someone that comes in and gets some good coffee. Unfortunately, not from some of the great shops that Mike Conroy was talking about. And, kind of back to just lastly, this employee experience, what's happening in spaces of, call it, small to medium sized companies, that's different today than it was, 10 years ago. Bart and I worked on a project kind of opposite sides of the deal, and this is seen across a bunch of others. All hand space for small to medium sized companies is ever more critical. When you're a large company and you have a large campus, there's plenty of opportunity to program that in. But when you're a small to medium sized tenant, all hand space, it becomes a big percentage of your footprint. And so how does that work? And I think at the ultimate sort of crux of it is, because a lot of these companies are still only in 2, 3, sometimes 4 days a week, when an employee comes to the office, they want to be fed, they want to learn something, they want to make a connection with their boss and their fellow employees, and they probably want to have a little fun towards the end of the day. And so the pressure to create all hand space, whether it's an amenity of the campus, but I think more companies are wanting to control that within their premises, has really been a consistent, more important sort of checklist on the tenant demands. And it kind of goes into, when I get that employee to the office, it's not to just have them sit at their desk and crank away code all day. I'm giving them something from an enrichment standpoint that helps my kind of recruiting and retention, that makes it worth their while to come in. So that has been an interesting trend that can be a little complicated depending on the size of the tenant, the size of the building,
100%.
exiting permitting. Yeah.
Yep.
Which
100%.
also, that right there contributes to some of the things we said earlier, why the Class A stock is in such high demand, right? That environment for that employee to make the commute in. We can program a lot of things internally with our TIs, but there's some external factors the tenant doesn't control, but the Class A developer provides. It is, seen such success of late.
Yep. Makes sense. Makes sense. As my final question for both of you here, give us a little bit of an overview, sort of end of the year into 2027, as we look at the submarkets, sort of the heat map around Silicon Valley. So what's happening? What do you anticipate kind of happening across the region?
Mike,
After you,
wanna go?
Bart. Sure. I'd be happy to go. So I think one thing I'm very interested in is the lease expiration dates that are forthcoming. So the rest of this year, we're tracking 1 million square feet of new office lease expirations. 27 will be just under 2 million, and then 2028 will be approaching 5 million. So, kind of a dramatic 2.5x from what 27 will be. And so the tenants in the market today do seem to be growing, not just because of all the great things going on in our local and national and global economy, but because a lot of these leases that have been signed in prior years are coming due. So that will be something from an inventory perspective and something from a demand perspective that is certainly already coming to light with tenants in the market that have some of those 28 expirations. Beyond that, I think we will see big reinvestment into a variety of projects that are trying to, replicate what newer construction product offers. And so demand in Moffett Park as downtown Sunnyvale is filled in. Demand up and down the Great America Corridor as Santa Clara Square is full. Will be, I would say, submarkets that are primed to see more activity. I'm very excited to see in kind of the Mountain View micro market what kind of clustering happens around OpenAI's new campus, kind of Middlefield, Ellis. So emerging submarkets that will see more demand because adjacent ones are full, and reinvestment that'll make older projects new again, is where I would expect to see a lot of the next articles to be written.
Yep.
I agree with that. I think demand's going to outpace any supply that anyone can create from a spec new development basis. So we're going to get creative again. We may get 80% of the way there with investments in existing kind of B plus stock, but it will be at 50% of the cost, let's say, to go develop new. That will be an interesting dynamic to watch how tenants react to that. And I do think on the R&D side, which we didn't spend a lot of time on, you'll continue to see record rents set throughout the rest of this year just because the number of Class A advanced manufacturing or kind of super R&D buildings is going off the market. We've seen leases this year at Supermicro with the Bridge project. We just saw what Archer did down in Morgan Hill. Our understanding of Prologis is more than oversubscribed in Milpitas. And every one of those is going to continue to raise rents. And we'll see who comes behind it, both tenants and developers, as they look to repurpose these antiquated sites. And the real decision is, do you go advanced manufacturing and bring back what was chased out of the market through the 2010 decade for the higher end office user? Or do you go place Class A office stock because there's such a demand for it? And we've proven that tenants will take it. So some pretty interesting headlines or pretty interesting storylines to watch as we exit the year. But all in all, I think we'll finish the year setting records as we did so far in the first half. Short of things out of our control, wars or things that may happen outside of the traditional real estate tech economies, there's no reason to think 27 won't show a lot of activity like we've seen so far in 26.
Yeah. Wonderful. Gentlemen, please stick around after I close the webinar here. I have just a couple of technical issues I need to deal with. But overall, thank you for your time. I want to thank also Alliance Roofing for their continued support of this webinar series. And to our audience, thank you for being with us, and enjoy the rest of the week.